I'll show you specific example properties that have sold recently and why I believe this suburb is going up in value by looking at the statistics and the growth from the suburb. These properties that I will show you have a greater than 5% return from the rental income. If you compare the properties that I'm about to show you to those in Sydney or Melbourne that are within a 15-kilometre ring, it's likely these ones are going to be about double the rental income than those properties in Sydney and Melbourne. This first booming suburb is called Morningside, and it's actually this suburb where I did my very first property deal. And it was in Morningside next to the train station that I built 5 houses. But this suburb is 5 kilometers east of Brisbane CBD, and I'll take you over to some properties which have sold recently, which I think are very good buying under 500,000. This one, it is a unit. I'm not very fond of buying units, but I do think that these properties, especially for the price point, will perform pretty well over the short to medium term. So it's a top floor apartment. You can see that there. And one other thing I just want to point out is that it's in a small complex. So when you are buying a unit, if you are in the market for units, be very selective. Make sure they're in very small complexes. Similar to this, low body corporate, no lifts, no pools. So your ongoing cost of maintenance is cheap. And also this is a fairly new building. So you're not going to have huge amounts of money spent on maintenance and things like that. You can see it's pretty nice and clean. It's a set and forget investment. This property just sold for $480,000, which I think is not a bad buy considering the construction cost on this unit alone would be almost that price. So to replace this unit in today's market would be almost $500,000, basically the purchase price. And this is it here. It's on 1762 Richmond Road. It is a bit of a thoroughfare, but it is on the corner of a really nice road in this area. You can see the rental return is going to be around about 550 to 600 with high confidence. And I'm just on realestate.com looking at this. 485,000 was a sold price. You can see even in 2015, it basically sold for the same price. Now we're talking about buying this basically at replacement value. Now I'm just going to show you some stats why I picked Morningside as a suburb and why these properties are going to grow in value. Have a look at the buy price. The typical price is $643,000. Typical rent $529 per week, and a yield typical is 4.27%. This is for a unit, remember. So then you have a look at typical prices. And you can see back in 2021, the unit market started to uptick across the board for this suburb. And we're in 2024 at the moment. So we're going 3 years of relatively steady growth for the unit cycle. But what I find more interesting, and generally markets follow a cycle, which is off the back of houses. So houses in this area have only started to uptick into their boom cycle from the start of 2023. So you can see at the start of 2023, they started to uptick. So we're really only about 12, maybe 18 months max into the housing market boom cycle. So as the housing market continues to grow, the unit market is more likely than not going to follow it because you got that pricing disparity, what you buy a house for versus what you can buy a unit for. And that difference in price is what's called the pricing disparity. And as that price gets greater, in other words, as houses get more expensive, units will follow suit in these areas, especially when you're talking about buying below replacement value. If you're buying below replacement value and new units come to the market, developers like myself, we have to build units to make a profit or have to build stock to make a profit, which means it's going to push up the surrounding stock in the surrounding suburb. The house to unit ratio is almost 50-50. So those graphs I just showed you with the unit price gradually increasing and now the house market going into that boom cycle again, it does mean that a lot of the market will be influenced by this housing boom. So the 53% of houses that are growing in value in their boom cycle, and admittedly the price on those will be in the order of 1.5 million plus generally. So that we're talking about 3 times the value of these other properties that I've just shown you. Then the supply on market for units. So you've got 8 listings, the stock on market on the top left. You've got 8 listings, 37.37% of total market listings. So there's virtually no stock that's on the market at the moment. The inventory is less than 1 month. So at the current sales rate, there'll be no stock left within 1 month. The hold period is 7 years. So hold period is how long people hold their properties for before selling. So 7 years is considerable. I like to more target a little bit longer than that, but 7 years is okay. Building approvals, none, which means developers are not building anything in the area. There's no building approvals in Morningside. You can look further abroad, and I'm not going to do that in this session, but there are other building approvals further abroad. And again, if you're buying below replacement value in a superior suburb, then that can only mean one thing over time. So you have a look at the stock on market over time is decreasing because we're not building enough. It's probably no surprise to you there. And then the demand, the days on market at the moment is 10 days, which is crazy. So in other words, properties are selling once they hit the market within a week and a half. A typical market in a capital city will sit anywhere from 60 to 90 days in a normal cycle. So 60 to 90 days on market, that's 2 to 3 months. Generally, a tight market is when you start to go below that 60 days on market. That's when it starts to become a seller's market. And when you're below 30 days on market, that's when it really starts to become a seller's market. So we are in a seller's market here. So if you're in markets like this, you got to be smart about your buying. You either got to buy the property basically the first day that it hits the internet. So you got to be on it all the time. And I have admittedly bought lots of on-market properties like this. Or you've got to be calling around the agents to get stuff off market before it even hits the market. Vacancy rate, that's the vacancy rate of rental properties. It's only 1.24%. Generally, a balanced market sits at around the 2 to 3% vacancy rate. So anything less than that is a tight market, and it means rents are going to continue to increase. And you can see over time, days on market, they've reduced over time, and also discounting. So you can see there's these little discounting is the black dots. Discounting is virtually not happening because with 10 days on market, you basically are paying list price. You might be able to just negotiate a slight discount, but you're paying list price because the market. Thanks so much for watching. Don't forget to like and subscribe this video. And if you love the content, please let me know in the comments below. If there's other areas you want me to analyze, please comment them as well. See you on the next one.